We thought this would be a interesting topic just to kind of defend our investment philosophy a little bit and look at a number of investments that are really popular, sold very aggressively out there, and just explain in a little bit more detail than we might get a chance to in a client meeting or a phone call, just why we don't use these. And so Quinn and I were kind of talking about a number that made sense. I said, I think we could do 4 in 20 minutes or so. And turns out we have a lot to say, so I might just jump into it here before it gets too long. And starting with the first one, high yield bonds, or sometimes these are called junk bonds. This is the biggest, most popular investment on the list. Also, probably the one we'll spend the most time on, just since they are so prevalent out there. It's such a big market and they're so common. So there's about $300 billion in high yield bonds out there in just mutual funds and ETFs that you or I can buy today. The total market is over $1.5 trillion. So this is a lot of pension funds, hedge funds, private markets. It's larger than the municipal bond market out there. So just a massive market here. So what makes these bonds different than, maybe what we have in your portfolios today? Unlike some other investments we'll look at in this webinar, these are not necessarily complex at all. They're really just simple bonds, so it's a loan that an investor is giving to a company in exchange for interest payments over time. The high yield or the junk term is really just used to describe a bond below a certain credit rating. And so what does a credit rating mean exactly? There's lots of companies out there that try to grade a bond. And so Moody's or S&P or Fitch are the big ones. They all have their own grading systems, as this chart tries to show here. Don't worry about all the details. Really, what's important to know is that these junk bonds are all bonds that were issued from companies that have below a certain rating from these rating agencies. And so there's this line in the sand between what's called investment grade, which are companies with relatively good financial health, so think Apple and Microsoft, very strong balance sheets. You can be pretty confident they're going to be able to make their interest payments. And then non-investment grade or high yield or junk, which are companies that, just not as strong of a balance sheet, potentially much riskier. And so what attracts all this money into junk bonds? $1.5 trillion thinks this is a good idea. What are they seeing? And I think for the most part, especially for retail investors, it's looking at these yields that these bonds offer. And so for the next few slides, I'm using a fund from iShares. This fund has the ticker symbol HYG just as an example. This is the largest junk bond ETF out there today. So I'm not just picking some obscure fund. This is a very popular one, tens of billions of dollars in assets. And right now, potential investors in this fund are looking at a yield somewhere over 7%. And that's great, right? What's not to like about a 7% yield today? To begin to understand why we don't believe these funds need a place in your portfolio, first I want to look at what the historic yield of these types of bonds have been over time. And so here's a chart from the St. Louis Federal Reserve, and it shows the yield of a junk bond index since April of 2007. And I picked April 2007 because that fund we just looked at, HYG, was launched in April of 2007. And so over time, you can see here the yield that bonds in this fund have had over time. Started around 7.5, pretty close to where it is today. Financial crisis led to the yield really increasing. And maybe just a simple point to make here, I put a line at about 5% on this chart, and you'll see why I picked that level in the next slide. But for now, just notice that for almost the entire time this fund has been in existence, since 2007, the yield on these bonds has been over 5%, and many places well over 5%, right? And so if you purchased this fund in 2007, held these bonds, this fund should have been tracking this yield over time. And so here's the big question. If you purchased this fund April 2007, collected these yields, what do you think your average annual return would be since 2007? Well, thankfully, the SEC requires funds to publish this performance, and this is a screenshot directly from the iShares Fund website. Since April of 2007, this fund has averaged an annual return of 4.75%. You'll notice that's much lower than what the yield was for just about the entire time this fund's been in existence. And so why is this so much lower than the yield that investors have been receiving in this fund? And that's because yield only tells part of the story for how these types of investments perform for an investor over time. And what we also need to consider, especially for risky investments like junk bonds, is how many of these companies are defaulting and causing investors to lose their principal. And so there's lots of studies on this. Tons of data here. This is a chart from a massive study from Moody's that looked at different default rates. More information than you want, but what you should know is that it's not uncommon that junk bond issuers default, go bankrupt, restructure, can't afford to make their payments. From 1982 to 2015, a long-term average was about 2.5% of these companies default every year. And of course, that spikes in times of kind of financial turmoil. It got up to just about 9% in the coronavirus pandemic. I think 2008 and 9 had about 7.5%. And what this means is that investors in these funds are getting a high yield. They're also losing their principal pretty consistently to the tune of, about 2.5% every year. And so this is just a chart that shows this another way. And this is the chart of just the share price of HYG, that ETF we've been looking at since April of 2007. You can see that even after more than 15 years, an investor who purchased this fund in April of 2007 now has their principal down about 25%. And so this is taking a huge chunk out of their total return, and a big reason why they're just getting that 4.75% in the long run average annual return. And so besides this default dynamic, there's a few other things to know about these funds that just lead them to not be great long-term investments. First, the fees on these funds are going to be much higher than what you're used to with a basic bond fund. There's probably lots of active management that needs to go, trying not to pick the companies that are going to go bankrupt. And so Morningstar says the average fee for these funds is just under 1%. That fund that I was showing you is one of the lower cost ones, about 0.5% in their fee that they charge, but still 0.5% every year in fees is really going to eat into your long-term return. And consider you can buy, a US investment grade bond fund or a treasury bond fund for maybe 0.05% or less. And so even though these junk bonds have higher yields, when you start paying 0.5% towards fees every year, that kind of eats into that added yield there. And also, if you buy these funds outside of a retirement account, IRA, 401k, or Roth, you're going to be paying more income taxes, compared to capital gains or dividends. You're paying the income tax rate on any interest, which tends to be 7 to 10% higher rate than you pay on some income you can get from stocks. And so finally, just as part of the bigger picture, how do high yield bonds fit in your portfolio? And the problem is that high yield bonds just have this they're in this unnecessary middle ground between two very good types of investments that you already have access to at very, very low expenses. That's stocks and investment grade bonds. High yield bonds have outperformed their investment grade counterparts over time, but they've also significantly underperformed stocks. And so this chart here is just to show the long-term performance of high yield bonds compared to US stocks. and then compared to an investment grade bond fund, which is just called a total bond market in this chart here. And also, high yield bonds tend to be very correlated to stocks, just meaning that when stocks decline in value, so do high yield bonds. And so that's pretty different from higher quality bonds that tend to have a little bit more stabilizing effect, tend to not do as poorly when stocks are doing poorly, and can just lead to not as much diversification in the portfolio. And that I'm just trying to show by this chart here, which shows how high yield bonds performed in various kind of crises that we've had recently. And so maybe just for example here, the subprime crisis in 2008, 2009, US stocks down 40 or 50%, treasuries or investment grade bonds just down a few percent, these high yield bonds down nearly 30%. And so just do not do a good job of protecting your portfolio, but don't give you the returns of stocks, that are a volatile investment. And so, if you want your money safe, the total bond market, investment grade types of bonds are very good for that. If you want growth, stocks have been much better, and you don't need to find something in the middle to try to do both of those at the same time. Moving on, the next type of investment we're looking at is what's generally called covered call funds. Sometimes these have creative marketing departments that like to use other terms like enhanced income or equity income or some variation of that. And so why is this topic on the list? I have a screenshot here. This is an ETF managed by JP Morgan. The fund is JP Morgan Equity Premium Income ETF. The ticker symbol is JEPI if you want to follow along. And this was one of the hottest new funds in the last few years. This fund went from zero to about $30 billion in assets over the last 3 years since its launch. And so right offhand from this kind of the fund's homepage, what jumps out to you? Like the previous example, it's probably that dividend yield, just over 7% here. And I think this is a huge reason these funds get a lot of attention. And then you can see some marketing speak here down below that. Monthly income, stock market exposure, but less volatility. And so why would an investor, not want that, right? And so first we have to kind of understand what these funds are doing. And the fund management is pretty simple. They own stocks and then they sell call options on the stocks that they hold. So what exactly does selling a call option mean? Options are just another derivative out there that can get complicated pretty fast. But just for this, webinar, a very high-level overview, a call option is just the right to purchase a stock at a certain price that's known as the strike price in some time period. And just to try to give you a simple example, here's the details from Apple's stock yesterday. When the market closed, it was about $188 a share. And below, I'm showing the details for the call options that exist for Apple shares. And what this option data shows you is just that I can purchase a call on Apple that gives me the right to purchase a share of Apple for $190. For 41 cents. In other words, if I buy this option for 41 cents, I can buy a share of Apple for $190 a share, no matter the price. If it goes up to $200, tomorrow, today, I can still buy it at 190. And so that's the intention of call options. What these funds are doing, though, is not buying call options, they're actually selling them. And so in this case, the fund owns Apple and it's selling that call option. So it's getting 41 cents from an investor. And if Apple reaches $190 or higher, that fund is going to sell Apple stock for $190. And so this fund sells the call and Apple never reaches $190, the fund keeps their shares of Apple. They still receive the dividends that you'd get like any normal stock investor would. And you also keep that 41 cents in this case from selling the option. And so that's what this fund from JP Morgan's effectively trying to do. They're trying to sell call options, get that extra income, that extra 41 cents every few weeks from their shares, and hopefully retain the Apple shares at the same time to give investors exposure to the market plus a little extra in income. And so hopefully that example just helped, made a little bit of sense. If not, don't worry, you do not have to understand the intricacies of options at all. Just try to maybe at a high level, the pros and cons of these types of funds are that they're designed to produce a little extra income. So you're going to get a little more income. That's that 7% dividend yield compared to, maybe 1.75 or 2% for the S&P 500 now. The downside is that, and this is very significant over the long run, as we'll see in a minute, is that the risk you have is that you lose out on most of the gains in the stock market. And that's because when you sell an option, you essentially put a cap on the gains that you can get with that investment. Remember in our example, if Apple hit 190 a share or higher, this fund has to sell it at 190. So if Apple goes to 200, they don't receive that entire growth. All they do is sell it at 190. They get no more growth after that. And so just to show the impact of this, I thought just a few quick charts would be the best way. Here's a table of the annual returns of this fund over the last 3 years. So notice 2022, S&P 500 had a very poor year, right? Down about 18.1% according to this. And this fund was only down about 3.5%. So this was a great example of a time when these funds do better than the general market. They do better because in a falling market, the shares are not getting called away at all, right? Apple's never hitting 190, it's just going down every day. And the fund can then just continue to collect those option premiums. So 2022 happened. Many investors saw this. Tens of billions of dollars flowed into this fund. And then what happened next year? 2023, the stock market did what it does very often, and that's bounce after a very strong year. S&P 500 went up about 26%. And this fund returned just under 10% for investors. And so what happened here? The stock market rose and these shares got called away from the fund. They were not able to benefit from the rising stock market because they had sold these calls, collected some income, but now cannot participate in the growth. And just to see what this does over a relatively short period, here's a chart of the performance of that JP Morgan fund in orange here, and then the S&P 500, the underlying index for this fund, is in purple. And what you see, despite very strong outperformance in that 2022 time, even just over a few years, we're seeing that cap in growth starting to make an impact in the total return that investors have. And this fund from JP Morgan's relatively new. There's another fund out there that's smaller, but it has much longer history that gives you a really good sense of over decade-long periods how this strategy can really hurt long-term performance. So this is a different fund, ticker symbol QYLD, and so here, instead of the S&P 500, it's doing the same strategy on the NASDAQ 100. And the chart here just shows you the orange line is a basic low-cost ETF that just invests in the NASDAQ 100. Purple line is the ETF that's doing this covered call strategy on the NASDAQ 100. And there are years here where that purple line or that Global X QYLD has outperformed the market. But in the long run, the cap on that growth is just too big of a barrier. Investors in the long run just cannot keep up with the general market. And so just as kind of a summary and a few other quick points about these types of funds, this is going to be a broken record for the rest of this rest of this webinar, these strategies have higher fees. And so I'm listing some expense ratios here. At the very least, probably 1/3%. And you can get much higher, closer to 1%. These are also can create some high tax liability, again, if outside of a retirement account. And that's because these option sales are taxed at high income tax rates. They're not dividends, they're not capital gains. And more importantly, just is that these funds just don't give investors kind of that good optimal risk that you should be taking. Because if the market declines, you're still going to hold on to those stocks that are declining in value. You will get some kind of added benefit because you're getting a little extra income, but you're still holding Apple shares when they fall 40%. It does not eliminate downside risk of the market. And then if the market rises, your shares get called away. You're left just holding cash as the stock market's going higher. You don't receive the gain. And so again, just not a good balance of risk and return for investors, as we saw in those last few charts. Next type of investment here is what we're calling buffered funds, or sometimes these are called defined outcome funds. This is very similar strategy, just a little bit more complex to what we were just looking at. So I'm going to go a little bit quick through these. This is the front web page of one of the buffer funds we're going to use as an example here. Ticker symbol is PJAN. And what these funds are trying to do is a very similar story. They are reducing the losses that you can experience from your investments in exchange for capping any kind of growth. They're just marketed very differently and can be a little bit more intricate in how they work. And so thought they'd be a good kind of separate topic here. And so in essence, how these work, very similar. They're using options, though instead of just selling options, they're buying calls and puts. They're selling calls and puts. Much more complicated, lots more trading going on behind the scenes, lots more derivatives to kind of get exposure in a very precise way. These funds do not own stocks at all, though. It's purely derivative based, usually just 4 holdings in the fund, calls and puts. And this is not a new strategy. It's kind of taken on a new life with marketing. They're new in an ETF that you or I or any other ordinary investor can buy. This strategy has existed for a long time in what's called a structured note, though. And so there's actually a good amount of history in how these types of investments perform. And so again, just I think the best way to show how these work is looking at a couple examples. Here's how this fund performed in 2022 compared to the S&P 500. Remember 2022, very bad year for the market. They're showing here negative 19.4% for the S&P 500. Over that time, this fund just declined 5%. And so this is a 15% buffer fund. And what that means is that the first 15% of stock market decline, they're protecting you from. So if the market declines about 20%, like it did in 2022, you're only losing 5%. And so this is good, right? And why, years like this happen, these funds get a lot of attention because of that outperformance. Very similar story to the covered call strategy is that the downside in these funds is that they're also capping the gains. The option strategies that they're using just result in you being unable to get over a certain amount of growth in any given year. And so, for example, now 2021, looking at a good year in the stock market, S&P 500 went up about 27%. This fund went up only about 9%. And so again, over the long run, this cap on earnings just really hurts your long-term return. This is a chart of this fund since it was created in January 2019. And so the charts, this fund is in orange. Purple line is just the S&P 500, and you can see about half of the return just over the last 4 years or so. And again, kind of common commonality between all these investments we're talking about: much higher fees. You're getting close to 1% in fees every year. That also just hurts that long-term return. High tax liability. And then again, just think about the risk that you're kind of the trade-off in these funds. And I think this is most important. What you need to kind of ask yourself is what kind of protection you need that you can't get with other types of investments. Because these funds can still lose money. They might let you lose a little less, but if the stock market goes down and you have a fund with a buffer of 9%, for example, the market goes down 40%, you're still losing 31%. So you are not immune to any kind of downside. There's just a little bit of a buffer there. And in exchange for that, as we saw, you give up lots of long-term gains. And so again, they just don't really fit into what we see as a good portfolio. When you need money in the short term, things like CDs are great, treasury bonds are great, money markets are great. They will cap that downside that you can get, right? As long as you're within FDIC protection and you're getting the full faith and trust of the US government with treasury bonds, you're not going to be subject to that loss that you can in these buffered funds. And then for the long-term money, the retirement savings that you're going to need 20 years from now, as we saw, you want stocks. You want that long-term growth. You don't need to worry about 9% drops in the market when you're looking at timeframes of 20 or 30 years. All right, and I know we're getting a little long here, the last investment, and I think this will be the shortest one also. We're looking at commodities. And just to be clear, this is funds that just hold the physical commodities themselves. We're looking at buying a barrel of oil. We're not looking at buying a share of ExxonMobil, just for example, and for clarification. And I think the biggest kind of sales pitch that commodities get is that they have some kind of store of value or inflation protection because they're a real physical thing that you can hold, right? You can put that barrel of oil in your backyard, I guess, and it's useful for society, so it should always have some value, right? And just as a spoiler alert, that's not always been the case. And so this is a chart I really like. It's a very long-term chart showing the inflation-adjusted price of oil since the 1860s. And the biggest takeaway you should see with this is that oil, despite increasing dependency on society that we have on oil, over the last 140 years, 160 years, has not kept up in value with inflation. In fact, an investor who bought a barrel of oil at its peak in the 1860s is down about 90% adjusted for inflation today. And so prices have been volatile. There's been periods where investors have done well in the short term, but oil, just as the first example here, has certainly not been this long-term guarantee store of value, guarantee protection from inflation, like is kind of sold out there for commodities. The same exists for gold and silver. This is a chart here just showing the period in the 1970s and early 80s where we had very high inflation, and then how gold and silver returned in those time periods. For example, 1981 was the highest inflation we saw in the period. Gold lost a third of its value still. Silver lost almost half of its value despite that inflation. And so just another example of how these commodities, especially gold and silver, is kind of marketed this way on that store of value, just really have not been. And again, kind of similar to some of these other options that we've looked at in the webinar, they tend to not perform well when other investments aren't performing well. And so this is just a table showing how gold has performed over time in various kind of market panics. And so again, let's pull out the subprime crisis, 2008 and 9. Gold lost 25%. Despite the fear that it seemed we were close to, the US banking system collapsing, when you would think gold actually really might have a value, but no, it's losing a quarter of its value, going down, just like about everything else. And then maybe the bigger kind of item here with any kind of commodity is that they just cannot produce good long-term returns. And that's because there's no real compounding growth that happens when you just have a barrel of oil in your backyard. There's no dividends, there's no interest, there's no earnings being reinvested into the company. A barrel of oil or a brick of gold is just going to sit there until you hope someone comes by and wants to purchase it for a higher price than you paid. And so this is a chart just showing a comparison of stocks, and then to one of the ETFs that has been out there the longest that just invests in physical commodities. And so we're looking back from 2007 to today to a Vanguard fund, that's the orange line here, and then this commodity fund in the purple line here. And so again, looking right before the financial crisis, even to this day, an investor in that fund down 70% in this commodity fund compared to more than doubling. Just again, this is just price, so not factoring in the dividends from stocks at all, just the price increase, more than doubling for the Vanguard stock fund. And so thanks for hanging in. I know that got a little bit long. It might have been too much to bite off doing 4 investments, but we thought this would be really helpful just to see a little bit more detail on why we make the investment decisions and recommendations for you that we do, and get a chance just to get into the weeds a little bit more. So please let us know if you have any questions. You can unmute yourself here and ask if you're comfortable in front of the group, or feel free to call or send Quinn or I an email, and we're happy to follow up that way. Thank you.